Futures and options are inherently risky and not suitable for all investors. Only risk capital should be used. An investor may lose more than the original investment. Past performance is not necessarily indicative of future results.
All right, so we got the old notes, the old 10-year notes here.
Yep.
And I had a pivot last night's letter, 127.25, and which I thought would be a place to bring in some weakness. Well, the low last night was 26.5, and it pushed away all day.
Right.
So I'm kind of thinking, and I had a pivot in bonds at 135.15, but I mainly had a price at 135.05.
Okay.
And I said, if that would stay intact, then the bulls are in the game still. Well, that's what's happened. And as you know, I mean, when I left the floor, we were pushing back to the upside.
Right.
So it looks like we want to go back into that range.
Okay.
So in 10-year notes, if we make the assumption that we'll pull back into the range, put a top in, and then break.
Yeah.
Is there a play we can use for that?
Yeah, there's obviously a lot of things going on in the treasuries right now. Something I've been watching very closely is actually the volatility. So,
which I've heard as a futures guy, non-option. I've always heard of market extreme.
yep.
That's okay.
Exactly.
Okay.
As an option trader, you want to monitor volatility really more than anything else. And right now, the options in the 10 years are fairly expensive given the recent selling pressure that we've seen in these markets. So, obviously options, they are not suitable for everybody. You should only use risk capital for this type of thing. Naked options, you can lose more than your initial investment, okay? So make sure this is something that's appropriate for you. But one thing I've noticed, excuse me, just got a fill on a bond reversal. Let me just adjust my stop here. All right. Yeah. Anyway, volatility has really exploded a bit here over the last couple sessions. So one way that somebody could potentially look to play this market right now is from a volatility standpoint. And if you think the market may start to calm down a little bit here, if you think the 10-year yield's starting to push the near-term highs, there is a way just to play the volatility aspect. And we're trading 128 and change right now on the 10 years. Okay, so one way somebody could play the volatility is by selling the at-the-money straddle for May. And by that I mean selling the 128 call option and selling the 128 put option. Okay, you're going to take in a gross premium of around $1,950. Okay, that does not include commissions and fees. Okay, it's 2 contracts, so you'll have 2 sets of commissions and fees, which you want to factor in. But basically, you're going to take in this premium, and what you're looking for is you're looking for volatility levels to die down a little bit. And if volatility starts to die down, those options will potentially lose value, and since you sold them, that's how you can potentially profit from this type of position. Okay, now you can calculate your break-evens at expiration by simply taking the net premium you took in, okay, and subtracting that from the strike price. So in this case, we're using the 128 straddle, okay, we're collecting, let's just call it close to $2,000 in gross premium. Your break-even's going to be a little bit above 126 on the bottom and a little bit below 130 on the top side, okay? Now again, you want to factor in commissions and fees in there also, but that's how you would calculate your break-even. And if the notes are anywhere in that range at expiration, the trade is profitable, okay? Obviously, the flip side to a trade like this is if the movement continues, volatility continues to expand, this is a naked position with naked exposure. So you have to have active risk management, and your losses can be unlimited with this type of position.
Got it. All right. That'll do it.
All right, Jeff.
Thanks.